There is a private rail car that left New Jersey in November 1910, carrying 6 men who had agreed, before boarding, not to use their surnames. They arrived one by one, so the staff would not notice them as a group. The cover story was a duck hunting trip. The destination was the Jekyll Island Club, a winter retreat off the Georgia coast, and the point of the secrecy was simple enough. Every man on that car had ties to Wall Street, and every one of them knew that if the public learned bankers were writing the next American banking law in private, the law might die before it ever reached Congress. The meeting lasted a little more than a week. Its consequences have lasted more than a century. Most histories treat the Federal Reserve as an American reform, born from the Panic of 1907 and signed into law on December 23, 1913. That version is not wrong. The United States really had suffered repeated banking panics, and the old system really was too brittle for an industrial power of its size. But the men on that train were not trying only to stop the next run on New York trust companies. One of them wanted something larger, a banking architecture that could turn the United States from a country dependent on European money markets into the country other money markets depended on. To understand why the Federal Reserve still provides dollar liquidity across borders when markets seize, you have to go back to Hamburg in 1868 and to the banker on that train who thought American finance was primitive. Paul Moritz Warburg was born in Hamburg in 1868 into a banking family whose house, M.M. Warburg and Company, already moved comfortably through the credit networks of Europe. He grew up in a world where bankers did not think of Berlin, London, Paris, Amsterdam, and Hamburg as sealed national compartments. They thought in bills, maturities, correspondence, and balances moving across borders. After finishing school in 1886, he worked in exporting, then at shipping and banking firms in London and Paris, and returned to Hamburg in 1895 as a partner in the family bank. That matters because Warburg did not arrive in the United States as a provincial reformer. He arrived with a working knowledge of institutions the United States did not have: central banks, discount markets, foreign branches, and a class of trade paper that could move across borders without waiting for some private titan in New York to decide the system deserved to survive the week. When Warburg moved to New York in 1902, he entered a country that was already rich, already industrial, and still financially improvised. The United States had no central bank. Reserves were scattered through thousands of banks and then pyramided up toward New York. National banknotes were tied in large part to holdings of government bonds, which meant the currency supply was rigid precisely when trade and agriculture demanded flexibility. Farmers needed cash at harvest. Merchants needed credit when inventories turned. Bankers needed a lender of last resort when fear arrived. The country had none. For Warburg, who had seen how European central institutions rediscounted short-term paper and stabilized funding when strain appeared, the American system did not look democratic. It looked unfinished. The weakness was easy to miss in calm years, because the system could function tolerably so long as confidence remained local and crop movements stayed within familiar seasonal patterns. But every autumn, money was pulled inward to move grain and cotton, and rates jumped. Every disturbance in New York threatened places far from it because reserves had already been drawn toward the financial center. The problem was not merely that the United States lacked money. It was that the wrong form of money sat in the wrong place at the wrong time. A large republic was being financed with a structure that scattered reserves in peace, concentrated strain in panic, and relied on private reputation, where other countries relied on public machinery. Warburg came from a European world where the central bank and the discount market were, in his own view, inseparable. Commercial paper could be turned into liquidity. Acceptances could finance trade and circulate because somebody stood behind the market in a crisis. He pushed those ideas in speeches and articles, and became an unofficial advisor to the National Monetary Commission after 1907. The diagnosis he offered was not mystical. He argued that the United States needed a central reserve, an elastic currency, and a market in short-term paper that could expand and contract with business needs rather than with the stock of government bonds sitting in bank vaults. He was not offering romance, he was offering plumbing. Then, on October 16, 1907, the old arrangement cracked in public. F. Augustus Heinze and Charles W. Morse suffered huge losses trying to corner the stock of United Copper. The failure ricocheted into banks linked to them. On October 18th, news that Knickerbocker Trust President Charles T. Barney had been associated with Morse helped trigger a run. By October 22, Knickerbocker had suspended operations. J.P. Morgan organized emergency support because no state institution existed with both the balance sheet and the legitimacy to do it. The crisis became the first worldwide financial panic of the 20th century. Industrial output fell 17% in 1908. Real GNP fell 12%. Only the Great Depression would be worse. Congress answered with the Aldrich-Vreeland Act on May 30, 1908. The law allowed emergency currency and created the National Monetary Commission under Senator Nelson Aldrich to study reform. Over the next 3 years, the commission traveled through Europe and examined institutions that already did what the United States could not: centralize reserves, rediscount paper, issue currency elastically, and coordinate the money market when strain turned into panic. It was a study mission, but it was also an education in hierarchy. The men on it could see, city by city, that the great powers already possessed monetary organs capable of moving quickly when private credit froze. The accepted account says this was a practical response to an obvious failure, and it was. But it leaves out the second fact. The reformers studying Europe were not just looking for domestic stability. They were looking for a way to move American finance onto the same international plane as London, Berlin, and Paris. And Warburg understood that better than anyone in the room. In November 1910, the party assembled for the most famous private working session in American financial history. Aldrich organized it. Abram Piatt Andrew came from the Treasury. Henry Davison came from the Morgan sphere. Frank Vanderlip represented National City Bank. Arthur Shelton served as Aldrich's secretary. Warburg supplied the technical architecture. To reduce the chance that porters or staff would identify them, the men boarded separately, used only first names, and kept to the fiction that they were hunting ducks. The secrecy was not theatrical. Aldrich understood that a banking plan openly associated with Wall Street could be politically fatal in a country where hostility to concentrated financial power ran deep, and with good reason. Warburg did not go to Jekyll Island simply to prevent another run on a trust company. He wanted to build an American discount market and an American acceptance market, underwritten by a central reserve structure strong enough to make New York competitive with London. That is the motive usually cut out of the schoolbook version. Warburg and the men around him understood that the United States had become a world power in output without becoming one in banking technique. American trade still depended heavily on foreign financial machinery. A central bank, in this telling, was not only a domestic safety device. It was an instrument for national elevation. The panic of 1907 opened the political door. Warburg intended to walk much farther through it than most of the public realized. The first part of his design was the discount market. A merchant bank extends a short-term loan against goods moving through commerce. That paper is then sold, or rediscounted, to a stronger institution in exchange for immediate cash. If the central institution will rediscount eligible paper in a crisis, liquidity can be created against current business activity instead of waiting for gold shipments or a rescue by private syndicate. Warburg believed this mattered because it changed the character of panic. Fear no longer had to force a solvent bank into suspension simply because depositors and correspondents wanted cash at the same hour. The paper could move. The reserves could move. The system could breathe. That was the theory, and much of the Federal Reserve Act was written to make it possible. The second part was what Warburg called an elastic currency. Under the old national banking system, notes were tied too rigidly to government bond holdings, which meant the supply of currency did not adjust cleanly to the short-term needs of commerce and agriculture. Warburg thought that arrangement was backward. Currency, in his view, should expand when legitimate commercial demand rose and contract when that demand was met. The intellectual scaffolding behind this was the real bills doctrine, which held that short-term self-liquidating paper connected to actual trade was the proper basis for note issue. The doctrine would later face heavy criticism, and rightly so, but in the years before 1913, it offered reformers a language for promising flexibility without openly inviting arbitrary expansion of credit. The third part was pooled reserves. Warburg argued for a central reserve, or central bank, that would hold the reserve funds of member banks so that collective resources could be mobilized when one bank or one district came under strain. This mattered because pre-Fed reserves were not merely decentralized. They were immobilized until too late. Money sat in thousands of institutions and then surged into New York, where the scramble for liquidity became most violent. A central reserve structure changed that by turning scattered self-protection into organized mutual support. It also changed the political meaning of credit. Once the reserves of the banking system are pooled, decisions about who receives emergency liquidity cease to be local. They become national. In time, they become international as well. Then came the piece that mattered internationally: the acceptance market. A banker's acceptance is a time draft accepted by a bank, which turns a private trade obligation into paper that can be sold and financed in a liquid market. London had long dominated that business. American merchants often had to route trade finance through British institutions and pay commissions into a foreign system. Warburg wanted the United States to build its own market in dollar-denominated acceptances, supported by a central institution willing to rediscount or purchase them so that they would circulate with confidence. That was not a decorative feature of reform. It was a direct attempt to shift part of the world's trade finance away from sterling and toward dollars, using central bank-backed market structure rather than speeches about national greatness. By the time the men left Jekyll Island, they had drafted the broad lines of a Reserve Association of America, one central institution with 15 branches across the country, holding member reserves, issuing currency, discounting commercial paper, and clearing checks. In technical terms, much of what later entered the Federal Reserve Act was already there. The lasting public myth is that the Federal Reserve appeared fully formed out of a later congressional debate. The record shows something less innocent and more ordinary. The engineering work had largely been done in private by bankers, a senator, and a Treasury official before the public argument reached its loudest stage. When people say the system was created by law, they are correct. But the first blueprints were drawn outside public view. On paper, the Aldrich Plan failed. It was attacked for giving too much power to bankers and too little to government. Its proposed board contained 46 members, only 6 appointed by the government, and the government itself would have had no stake in the institution. After the 1912 election, with Woodrow Wilson victorious and Democrats controlling both houses, Aldrich's chances were finished. Yet failure at the level of sponsorship did not mean failure at the level of design. The political shell had to change. The technical core did not. This is one of the oldest patterns in financial history. Structures that are too exposed to survive under one name return under another. Altered just enough to pass, intact enough to matter. That translation was handled in Washington by Carter Glass and Henry Parker Willis, working under Wilson's insistence that any central banking law needed an oversight body visibly tied to the government. Glass preferred strong regional banks. Wilson wanted a central board. Bankers wanted influence without obvious ownership. The compromise produced a hybrid. The final bill kept the decentralizing language needed for American politics while preserving enough central machinery to do the work Warburg thought necessary. Federal Reserve history puts it plainly. The technical details of the final bill closely resembled those of the Aldrich Plan. That sentence is more consequential than it looks. It means the public fight changed the packaging, but much of the operating logic still came from the men who had ridden south under assumed simplicity and private discipline. The law signed on December 23, 1913, created between 8 and 12 reserve banks, with 12 ultimately chosen, and a Federal Reserve Board made up of presidential appointees and ex officio officials. It also created the Federal Advisory Council, so bankers would retain a formal voice. What emerged was neither the pure public institution populists wanted, nor the banker-run Reserve Association Aldrich had first championed. It was a public-private machine. The language of decentralization softened the fear of Wall Street control. The architecture of rediscounting, reserve pooling, and coordinated note issue preserved the essential functional changes Warburg had pursued. The point was not to eliminate financial power. The point was to reorganize it into a system that could claim public purpose while operating with techniques drawn from high banking. The reserve banks opened on Monday, November 16, 1914, just 7 months after the organization committee announced the districts and cities. The rush was real. World War I had already begun in Europe in August, and commerce was under strain. Some reserve banks had temporary offices. Treasury Secretary William McAdoo told them to buy a few chairs and pine-top tables, hire clerks and stenographers, paint Federal Reserve Bank on the door, and open. Minneapolis began with as few as 8 employees. New York opened with 85. Paul Warburg, appointed by Wilson, took his place on the first Federal Reserve Board on August 10, 1914. 2 years later, he became vice governor. The engineer was now inside the structure he had spent years trying to build. That arrangement altered more than panic management. The Federal Reserve Act allowed national banks to issue bankers' acceptances and open foreign branches. It also authorized reserve banks to purchase acceptances in the open market, which meant the new system could provide a liquid backstop for a market the United States had previously lacked. This is the hinge on which the story turns from American reform to global consequence. A central bank was not only going to rescue domestic banks from seasonal strain, it was going to help make the dollar usable in international trade finance at scale. Warburg and other internationalists around Benjamin Strong wanted the United States to act like a world financial power because, in production and diplomacy, it had already become one. The banking technique had to catch up. The effect was rapid. Federal Reserve history notes that by the second half of the 1920s, more than half of American imports and exports were financed by dollar-denominated acceptances, and a large share of the international trade of other countries was financed that way as well. By the mid-1920s, the dollar had become the world's leading reserve currency. In other words, a mechanism first defended as a cure for domestic panic was now helping determine which currency sat at the center of world trade settlement and reserve accumulation. That did not happen because merchants around the world spontaneously developed patriotic feelings toward the United States. It happened because a market had been built, a backstop had been supplied, and confidence had been engineered. Warburg did not create American industrial power. He did help create the monetary and institutional channels through which that power could be financed, moved abroad, and then depended upon by others. That is a different order of achievement. And this is where the usual schoolbook version runs out. The familiar narrative says the Federal Reserve was created to prevent panics. True. But it stops before the part where the same institution helped build a dollar market capable of pulling global trade toward New York. It stops before the part where central banking becomes a method of statecraft. And it stops before the part where decisions first drafted for American reform start reshaping the options available to banks, merchants, and governments far beyond the United States. Warburg saw that horizon early. He belonged to an influential group that thought a central bank was integral to America's larger international role. The system was national in law. In intent, and soon in consequence, it was larger than that. World War I tested the newborn system almost immediately. The war began in Europe before the reserve banks had even opened. At first, it triggered financial panic and a gold outflow from the United States. Then American exports rose. Gold poured into American banks, and the new Federal Reserve lacked the maturity and tools to offset the surge. Money supply rose. Inflation followed. This part matters because it shows how quickly central banking ceased to be an abstract reform and became an operating lever inside world events. A structure built to manage liquidity at home was already being bent by international conflict within months of opening its doors. The architects had built an instrument for stability. The world handed them a machine for scale. Once the United States entered the war in 1917, the Federal Reserve became central to financing it. Reserve Bank governors chaired committees selling Liberty bonds. The banks encouraged member banks to buy Treasury securities by offering preferential discount rates on loans secured by government bonds and notes. Here the line between monetary reform and state mobilization became unmistakable. A central bank with pooled reserves and note-issuing capacity could support the fiscal demands of a modern war in a way the old patchwork system could not. None of this means Warburg built the Fed in order to fight a European war. The record does not support that claim. It does mean that once the architecture existed, the state discovered very quickly what it could do with it. Cooperation moved outward almost immediately as well. A later history of central bank cooperation notes that on May 3, 1917, the Federal Reserve signed its first reciprocal account agreement with the Bank of England. Benjamin Strong at the New York Fed pushed hard for the development of acceptance finance and for a more outward-looking role in international markets. The discount market, the acceptance market, and central bank cooperation were not separate stories. Warburg himself had insisted that the central bank system and the discount system could not be separated because they were absolutely interdependent. That sentence reads today like a technical observation. It was also a map. Build a central bank that can support the market in trade paper, and you do not just stabilize domestic finance. You begin to reorder who intermediates world commerce. None of this looked sinister to its architects. That is worth being fair about, because the record is stronger when it is not theatrical. Warburg had diagnosed real weaknesses in the pre-1913 system. The panic of 1907 had exposed them brutally. A lender of last resort was not an invention of paranoia. It was a response to repeated failure. But solutions in banking do not stay where their inventors first placed them. A central reserve meant that private institutions now operated above a shared emergency floor. A liquid acceptance market meant the state was helping create the conditions under which private trade paper could circulate more widely. The gain in efficiency was real. So was the gain in concentrated power. One did not cancel the other. But the arrangement carried an assumption that would trouble the 20th century again and again. It assumed that the paper being supported was short-term, commercial, and disciplined by real economic turnover. It assumed that the boundary between productive finance and speculation could be maintained by rule, judgment, and institutional culture. It assumed, too, that people operating inside the machinery would recognize the moment when credit had moved from trade into froth. Those assumptions did not hold cleanly, even in Warburg's lifetime. Once a central institution exists, markets learn around its language. Eligibility rules become pressure points. Backstops change behavior. The very confidence a lender of last resort creates can invite the kind of leverage that later justifies another rescue. The plumbing solves one problem and breeds the next. Warburg saw some of that danger early. Federal Reserve history records that in March 1929, he warned that wild stock speculation and improper bank lending practices would have disastrous results if left unchecked. On October 29, 1929, the market crashed. That warning matters less because it excuses him than because it clarifies the limits of architecture. The man who helped create the machinery could still watch credit move in destructive directions once politics, incentives, and euphoria took hold. Design matters. It does not abolish appetite. And once central banking has become a central fact of national life, its failures are no longer local stories. They are stories about the entire credit structure of the country, sometimes of the world, wobbling on a single set of judgments. It would be lazy to lay the Great Depression at one man's feet. The record is too tangled for that, and honest history has to say so aloud. The Federal Reserve of the early 1930s was a young, divided institution, working under doctrines that constrained it, and personalities that did not agree. Yet the Depression still reveals something important about Warburg's achievement. Once the central bank existed, it became impossible to treat monetary breakdown as a merely private embarrassment. The failures of judgment inside the system, or the failure to use the system aggressively enough, now had national and international consequences because the system itself had become central. Before 1913, America lacked organized monetary power. After 1913, it possessed that power and had to live with the scale of its mistakes. What changed forever was not simply that America had a central bank. Other countries already had those. What changed was that the United States now had the institutional means to turn domestic credit management into international financial influence. A rediscounting system could support commerce. An acceptance market could denominate trade in dollars. Foreign branches could carry that reach abroad. Reciprocal accounts, and later swap arrangements, could extend it under stress. The old world in which American banks depended on European market structure for international trade finance began to reverse. Over time, others would need access to dollar funding because the channels of trade and balance sheet management had been built to run through dollars. That is how a reform becomes an empire of technique. Before the Fed, a panic could begin in New York and wreak a harvest in Kansas. After the Fed, monetary choices made in Washington and New York could help shape credit conditions across continents. That widened both the protective promise and the range of the damage. When a system is decentralized and fragile, it fails often and in fragments. When it is centralized and authoritative, it can fail less often but on a larger scale. People tend to notice the first half of that sentence and neglect the second. Warburg's design reduced dependence on one private banker like J.P. Morgan. It also helped build dependence on one national monetary architecture whose signals, rates, and emergency facilities grew more consequential with every decade. That concentration produced gains, but it altered the human geography of failure. A merchant once worried about his local banker, the freight rate, and the harvest. His grandson had to worry about the discount rate, the bond market, and the availability of dollars in places he would never see. A government could now finance war more efficiently. An export house could finance trade in its own currency. A foreign bank could build a balance sheet around dollar liabilities because the market seemed deep and the backstop seemed real. Those were advantages. They were also dependencies. The modern citizen inherits them in quieter forms: mortgage costs, pension valuations, business credit, imported fuel prices, and tax capacity are all touched by the condition of a monetary structure drafted when 6 men on a train still thought secrecy itself might save the bill. And what happened to the men who built it is the part most accounts handle too politely. The trip to Jekyll Island did not end their careers. It advanced them. The secrecy did not disqualify the plan's authors from future influence. It protected the plan until politics could catch up to its design. The public was told, with reason, that the nation needed stability. It was told, also with reason, that Wall Street should not be handed an undisguised monopoly over the country's reserves. Both concerns were real. But the men who had done the most important technical drafting in private were not pushed to the margins once the law passed. They were woven into the institutions around it. Their assumptions turned into procedure. Their market preferences turned into national habit. Warburg resigned from the Federal Reserve Board on August 9, 1918. That was not disgrace. It was passage into the next layer of influence. He later served on the Federal Advisory Council from 1921 to 1926, founded the American Acceptance Council in 1919, and in 1921 organized the International Acceptance Bank to promote financing for post-war reconstruction in Europe. He remained a prolific writer on monetary affairs and, at his death in 1932, chaired the Manhattan Company, while serving as a director or senior figure in several other institutions. The man who had helped write the country's central banking architecture did not vanish into reproach. He remained near the command posts of the financial world his ideas had helped enlarge. Nelson Aldrich lost the explicit political fight over the National Reserve Association. Yet the technical structure he had carried out of Jekyll Island survived inside the later law. Frank Vanderlip went on writing and speaking as one of the country's best-known bankers. Henry Davison remained a central figure in the Morgan orbit. Benjamin Strong, though not on the island itself, became the first head of the Federal Reserve Bank of New York and one of the most powerful central bankers of the 1920s. The point is not that these men escaped prosecution for some codified offense. The point is sharper than that. A decision of enormous constitutional and financial consequence was incubated in private by people with direct interests in the outcome, and the result of that incubation was not exclusion. It was authority, the same pattern held around the institution itself. The Federal Reserve did not remain a modest regional compromise forever. The Banking Act of 1935 increased the authority of the board in Washington over the reserve banks. Power drifted toward the center because crises rewarded coherence and political systems reward the officials who can act in emergencies. The rhetoric of decentralization remained useful. The operating reality kept centralizing. Nobody dismantled the machinery. Nobody sent it back to the counties and crop towns from which banking strain used to rise. The architecture stayed. It became ordinary. And once a financial arrangement becomes ordinary, its origins stop feeling political, even though its consequences remain so every single day. You can see the afterlife of Warburg's design most clearly when the modern dollar system comes under pressure. The Bank for International Settlements noted in March 2023 that outstanding obligations to repay dollars in foreign exchange swaps and forwards amount to more than $80 trillion, a figure larger than the stock of dollar treasury securities, repo, and commercial paper combined. Those obligations sit largely off the usual debt measures, but when stress hits, the scramble for dollars is real anyway. And when that scramble becomes dangerous enough, the institution that steps forward is the Federal Reserve. Not because Congress debates each case from scratch, because the architecture of central bank-backed dollar liquidity is already there, waiting to be used. The old logic is visible beneath the modern complexity. A market that treats dollar funding as indispensable still assumes that, in the last hour, There is a superior balance sheet somewhere above it. The Federal Reserve says those liquidity swaps exist because funding markets are global and their breakdown can disrupt credit to households and businesses in the United States and abroad. The modern arrangements began in December 2007 with the European Central Bank and Swiss National Bank, were revived in May 2010, and in October 2013 were converted into standing arrangements with major peer central banks. Mechanically, the operation is plain. A foreign central bank temporarily exchanges its own currency for dollars at the Federal Reserve, then lends those dollars onward in its jurisdiction, and later reverses the trade at the same exchange rate. Their stated purpose is prudent enough: to improve liquidity in dollar funding markets and serve as a backstop in stress. But that plain bureaucratic language describes a remarkable historical fact. When banks and non-banks outside the United States cannot obtain dollars smoothly, the central bank created out of an American panic can now extend dollar capacity through foreign central banks to stabilize markets far beyond its original domestic field of action. That is the present tense meaning of the trip to Jekyll Island. The train car, the first names, the duck hunting story, the argument over reserve concentration, the discount market, the acceptance market, the compromise between public oversight and banker expertise, none of it stayed in 1910. It matured into a world in which the dollar is not only a national currency, but a funding infrastructure. This is why the phrase "global banking forever" is not journalistic excess, if it is used carefully. Warburg did not invent money, credit, or central banking. He helped design the American version that became deeply entangled with world trade, reserve accumulation, and crisis management. He changed the operating grammar through which a great deal of modern finance still speaks. Money becomes geopolitical power when a private market knows a public balance sheet will stand behind it in the last hour. That is the portable lesson in Warburg's career. He understood before most Americans did that banking supremacy would not come only from wealth or even from industrial output. It would come from architecture, from the institutions that decide what counts as liquid, what can be rediscounted, whose paper circulates easily, and who receives the emergency line when confidence fails. It would come, too, from persuading the world that dollar paper could be trusted in a storm, because an institution stronger than any individual bank stood behind the market as a whole. The accepted story of the Federal Reserve says America finally built a central bank after one panic too many. The fuller story is that a German-born banker helped build the monetary framework through which the United States learned to project financial power, absorb shocks, and export its currency's logic to the rest of the system. If you stayed with this story to the end, you now have a heavier version of Federal Reserve history than the one most people were given. You know the institution was born, not only from panic, but from a deliberate effort to redesign the channels of credit and trade on which national power rests. If you want to mark that you made it through, leave the train emoji in the comments. And if you want more histories built this way, with the financial architecture beneath the familiar event left fully visible, subscribe. These pieces take a long time to research, and your support keeps them possible. There is more of this record still to surface. Until next time.